Hello, Royalty Kings. Welcome back to the Royalty King Report, long form conversations on capital markets. And today I have a young Royalty King that I'm converting to the capital light business model. We're talking ports, we're talking some interesting plays in terms of royalties in the pharmaceutical sector, and lots of other things. My guest is Hugo Navarro from Valencia. He is a value investor, and he's also, a lot of people don't know this, he's also a stunt double from Vampire Diaries. So very popular man amongst the ladies. Hugo, welcome back.
Thanks, Benjamin. A pleasure being here.
Oh, look, it's always a pleasure. Lots of interesting developments happening.
Yeah,
Let's talk about an idea that I've always had in the back of my mind and I've never gotten around to it. You know what I mean? So ports, infrastructure, airports, I haven't gotten around to that yet, but you have done a lot of work in
yeah,
shipping ports, and you put out a very interesting report that I read during the week all around that. So let's dive straight in. What I
sure.
like about these models is that they're a type of toll booth in a sense, and they're very hard to replicate. So why don't you give me the 2-minute overview of ports and infrastructure,
Mm,
why that caught your attention, and then we'll talk about I suppose, the two names that
yeah,
you're most well known for in that
sure.
space.
So, the main interesting thing about infrastructure is that historically it performs better in down markets, like it goes down less. It's anti-cyclical. Not anti-cyclical, but is recession resistant,
Right.
especially regulated types of infrastructure. It's a business model, an asset that is in most cases really difficult to replicate. It's not disruptable by AI. Anthropic is not going to put a tweet and the stock goes down like 10%.
Four,
So
build me a port, make it cheap, make no mistakes.
yeah, yeah, make no mistakes, really important.
Yeah.
And yeah, and the thing here is it's something that I see predictable over the next 10 to 20 years. That's something that the market, I think, will price more and more over the coming years as AI continues to evolve. Because I'm a little bit skeptic on AI, but what is clear is that uncertainty will be a big factor going forward. Because these things will keep evolving. Not sure if they will be economical, if they will replace tons of jobs, but the stock market will be uncertain. So infrastructure is certain about will be 10, 20 years. We'll still need electricity, we'll still need airports, still need ports. So that's a big factor. Then, most of these businesses are already priced in. A great business, big moat, most of them are practically monopolies in some geographical areas. So that's already in the price. But that's where my work comes in, and I start digging into some of the most interesting names to see if there's some mispricing. Like I get an interesting asset class, I narrow down in this case to ports, because that's the most interesting thing, is that they are geographical monopolies, because there's not ton of ports. Each one dominates an area. Uh, so that's why I see them as very interesting. And then I narrow down to the two names we are going to talk about now, which is the two biggest Greek pods. So, quick disclaimer here, we are talking about Greek securities.
Okay, no, that's a very good synopsis. You've done well straight off the bat. And if we think of, well, the way I represent these mentally is these are kind of like nodes and key hubs. And if we're talking about Europe, I was very surprised at the fact that the market has not really appreciated the position these ports have. So throughout the universe of ports that you mentioned in the paper that you put out, there were two that were trading, if I remember correctly, at single digit multiples on their
Yeah,
EBITDA, and that really caught my attention because this is the type of thing, as you mentioned, these go back millennia. They've always been different port cities, right? So that has strategic advantages to civilizations throughout history. And so clearly we can say it's a very robust business model. We've focused on Europe thus far. So why don't you take the chance to tell me a little bit about the two port cities in Greece, why you've identified them specifically out of this, I suppose, sub-universe as having structural advantages moving into an uncertain future.
Sure. Like we have three main factors in this thesis. Like we'll start from the bottom and let's go, to the macro picture. Like for the bottom up, these are two pods that are trading at 5 to 6 times enterprise value to EBITDA. Both have net cash positions, really strong returns of capital. And since they have been privatized, they have grown at high single digits to low double digits, really strong growth for an asset of this type. Usually they are very mature, but we need to understand where this comes from. We come from a situation where the Greek state was bankrupt, so they were
Mhm.
investing nothing in these spots. And then we have some players we will talk about later about the owners. They came in, they start putting money, and they get really good returns on that capex because they don't make like silly European improvements. They make real improvements on infrastructure that has been under investment invested in by 12, 15 years, really underinvested. So they really have good returns of capital, and they should be able to continue to do that because they have some big projects around for the expansion. We will know that later. Then the second factor is those big projects around expansion. In Thessaloniki, they recently got approved a project to go from 650K TEUs to 1.5 million. That will cost 200 million and 40 months. But
Okay,
that basically will
let me stop
double
you there
revenue.
for the viewers that are not familiar. It's a tricky metric. TEU
Yeah,
is 20-foot equivalent unit. It's a silly American metric, I would
yeah, it's
say.
basically for containers, like
Right.
Big
And so
Macs per
the
square
point
meter.
the point being the capacity for volume at this port is
Yeah.
due to really significantly increase, and volume is a key function of their revenue
Yeah,
model.
correct, correct. So we have a big expansion there, and then on the PIO side, like they will continue to do some investment in the passenger terminal, on the car terminal. They have demonstrated in the past they have earned really good returns, like 20% over 20% is the average return on investment capital over the last 3 years. Even if they achieve less, this will have some significant growth. And the third factor is the macro picture, is that if we look at the trading routes, China is rerouting a big part of volumes through Greece. And that's really important. Like we have the trade route
Very
that goes, you know, from Iran, from Turkey, and that's pretty risky. And then we have the other one that goes through the Red Sea, and they want to kind of improve that. Basically, Greece could become the main gateway to Europe. And
right.
that's, the big macro thesis. We will dig now a little bit on that, but just to note, this is not what drives the thesis. This is a long term tailwind, a call option that could mean that we are owning these assets for 5 to 6 enterprise value EBITDA, and these assets are basically key to Europe, like really low valuations
Absolutely.
for a star asset.
I think that I think that deserves a little more underlying or emphasis because the state of the world at the moment, if you're China, and since 2008, basically, China's rise mainly on the back of exports. If you're exporting something, by definition, that needs to travel either via air or mainly via sea. And that obviously requires a ship to have a certain trade route and destination. And at the end of that destination, what do you know? There needs to be a port with certain key infrastructure that can receive the cargo and distribute it via rail in the case
Yeah.
of Europe.
And that was the problem in Europe, especially Southern Europe, Greece, the Balkans, Serbia, Bulgaria, all of those countries. They didn't have a reliable train system. So we have a big case of I think between Bulgaria and Serbia, China just went and they funded a railway
Mhm.
through those two countries. There was lots of noise in the media because Europe didn't want that to be built with Chinese funding. But if you take a look a little bit of the details, it seems like Europe prefers Turkey to win in this race than Greece, which it makes little sense. But as this road is China funded, there's some concerns around that.
Right. Yeah, your mates in Brussels are a little angry with the
Yeah,
Greeks. They've got a bit of a chip on their shoulder for certain actions in the sovereign debt crisis. But be that as it may, we've got a few factors. So this now new paradigm since COVID, where we're deglobalizing, that makes supply chains that had become used to certain efficiencies in their operation, that's all being unwound. So cost of transport is going to increase. But if you've already got the infrastructure there, essentially we're looking today at two opportunities to own really a gateway to
yeah,
Europe, if you want to look at it that way.
yeah. The thing here is there's a caveat, is that as in the Eminem song, like they have to catch the opportunity before it's gone, because
Yes.
the railway system, especially in Greece, it's really underinvested. And it's what called Corridor X, that it's basically the spine of all Southern Europe of the rail system. That's really underinvested, and there's lots of programs to improve that. If that comes in reality, and we have like in 2028, 2030, it should be before, according to current programs and current deadlines. But we will have all electric cars by 2030. So I would not rely on European Union deadlines. So if they are able to successfully improve the rail, we should have a pretty big chance of Greece becoming a gateway to Europe. And that's like the long dated call option, I would say,
Mm.
for these two pods. And we need to understand, we have to enter into the details first. On the infrastructure, Piraeus basically uses no railway at the moment, because Piraeus is at the, like, if Greece is this, Piraeus is here, and Thessaloniki is here. So
Mhm.
Thessaloniki is already on the north, and it has direct rail access. Um, Piraeus does not have it. Like, it relies 0% on rail at the moment.
And this
It's
is a good
mostly
chance
a
of
transshipment port.
explaining
What?
the difference. This is a good chance to explain the difference between a transshipment
Yeah,
port and a gateway port. So why don't you explain
yeah,
the difference between those two models and then apply it to Thessaloniki and
yeah.
Piraeus?
Sure. So basically, transshipment is like you go to a port, like to recharge, and then you go to another. That is the port where you are going to get the goods and distribute them. Uh, Thessaloniki is a gateway port. It's a port where you drop the goods off and they are distributed. They are a gateway port because they are smaller and they have direct rail access. That's a big advantage. They are on the north and they are the gate to the Balkans, basically. With that increase in capacity, they should be able to ship more volume, and we are already seeing strong demand. In Southern Europe, they are growing at 2-3%. It's one of the strongest economy around Europe. They are growing quite a lot. And then Piraeus, the problem is, from Athens to Thessaloniki, the rail system is incredibly underinvested. It's not reliable. And also between Piraeus and where you need to ship from Athens to Thessaloniki, that part also it's unreliable. So we need more things to work on Piraeus for it to become a gateway port than on Thessaloniki. Thessaloniki has a short-term advantage there, because as in the north part, it seems to be advancing faster. So they will be the first one to get that big boost on volumes and on utilization. Piraeus, the thing is long-term opportunity, because Piraeus is majority owned by Costco. Costco is owned by the Chinese government. There's some links to that. So it's quite clear that Piraeus will be the gateway for China and their main export route once all of this is working. But this is macro. This can take a decade. So for
Sure.
me, I prefer Thessaloniki as this shorter term, more measurable. What's working, what's not, and the huge increase in capacity from the Pier 6 expansion project. That's the one that will take the 650k TOs to 1.5 million. That's tangible. That's easy to measure. Piraeus, it's really hard to get a sense of how much will this affect the company. And also you rely on the Greece railway infrastructure. That's not something I like, but both are pretty good. I already touching on the ownership part. Both pods have a small stake. That is the Athens government. So that protects us, in my opinion, from a takeover. Like if Costco will want to take this private, it will be harder because there's that stake from the Greek government. And the same on Thessaloniki. Thessaloniki is quite curious. There's an interesting story here. Basically, maybe tomorrow I am and I get shot or something, but it's basically owned by a Greek Russian billionaire with quite a lot of power in the area. He owns one of the football teams in there's a funny story. That guy that owns like 70% of the company. It's a billionaire. He also owns lots of real estate in the area. He has been politic in the area.
Yeah. He's not interested in a takeover. Let's put it that way.
No, there's something interesting, quite funny. If you take a look, he also owns the football team of one of the cities, and there's like this final, and he pulls a gun on the final because there was a goal or something like that, and the referee made something, so he entered the football camp and he pulled a gun. It
Well,
was
that's
yeah.
just a domestic league match in Argentina every weekend
Yeah,
that
yeah,
happens.
that's completely normal. So I guess we kind of have a possibility of getting an extension of the concessions that guy on the management. Uh, yeah, a little and detail on that. As every pod, these are run on concessions. These concessions are favorable, incredibly favorable. Most of them have like high percentage of revenue. These are around 3% of revenue as fees. It's incredibly low. The mandatory investments were investments that were going to deliver tangible financial results and tangible benefits. So that's good also. And they run until 2051 in Thessaloniki and 2052 in Piraeus. So there's still quite a lot of time. Basically, if you do a DCF,
Mhm.
that's 14x free cash flow multiple with an 8% WACC, 3% terminal growth rate, which is conservative for this because they have quite a lot of pricing power above inflation.
Mhm.
So yeah, that's basically the history. Main thing here for value investors, this is incredibly discounted. If you did the valuation, if you do the DCF, this is crazy cheap, but there's no catalyst in the short term. That's a big factor, I would argue, for this being so massively mispriced. Then the other factor I think I would argue here is that there's a governance problem, with Costco as a major owner in one and the rich guy in the other one. You might say this will be run for personal interest rather than uh, these minority stakeholders, but they pay pretty good dividends, plus 50% payout ratios, growing dividends. So I don't think there's a big concern on that. And there's an example in Thessaloniki last year. A fund tried to create a position in the pot. So they did a tender offer. They say we will buy the shares at 27. So the major owner of Thessaloniki, he say, "Oh, I will start buying every share that it's in the market at 29." So
Mhm.
nobody took that offer. So right now it's around 34 Thessaloniki. I think that 29 price sets a good floor on what the valuation
Yep.
looks like on a bear case,
Yep. So
because they will just buy
Thessaloniki
more.
Port closed at 36 euros. We're talking
Yeah,
euros, people, and 29 we think is a bit of a Savides put under the
yeah,
stock price.
yeah.
Okay,
Completely.
and what about Piraeus? What's happening in terms of Piraeus for a valuation lens? What are we thinking?
Yeah, Piraeus is similarly cheap, around 5-6 times enterprise value EBITDA. When I talk about EBITDA, cash conversion is pretty good. You can check that. They have not much capex on normal years. Maintenance capex is pretty low, and yeah, the cash conversion is good. And I think tax is around 22% on Greece right now.
Not bad.
So it's pretty good free cash flow conversion. They have 57% EBITDA margins on Piraeus. Uh, we have to make like a note there, is because Piraeus has three peers. Two of them are leased to Costco. So
I see.
that's
Okay.
basically high margin royalty, because they just own like picture how cheap they are getting the concession at. They pay like 3.5% of revenues to the Greek government, and Costco pays them 25% of revenues for operating those two piers. So that's really, really good. A big thing of Piraeus, the story of Piraeus is going from transshipment to gateway. If you take a
Mhm.
look at the TEUs, they have been going down over the last years, but revenues have been going up because more volume is for Greece, as Greece has been growing quite quickly, and in the future it should be for the Balkan zone and Southern Europe.
Yeah.
That's
So
the main history in Thessaloniki. Case here
okay.
is for double-digit growth over 5 to 10 years.
Okay. Well, that's certainly reasonable.
Yeah,
Oftentimes, when you see an infrastructure co that's priced so cheaply, it's because people think it's a stalwart and it's not really going to grow, but it doesn't seem to be the case. There are a lot of catalysts for
yeah,
growth, and there's a very reasonable return on equity demonstrated already in the base cases for these companies. So
yeah.
mid teens to even a few years in the 20% return on equity. So that's good. And is it fair to say then that gateway revenue is a little more, or gateway profits are higher margin than transshipment, or is it the other way around? Is
It
that why they?
depends on the pod, but I think they are higher on the normally it's higher gateway, just because this is operational leverage. If you do more services, you will just gain more profit. And it depends a lot on the services. In the case of Piraeus, it is for sure. You can just take a look at the margin evolution as they do more gateway compared to transshipment. Even when volumes go down, margins go up. So it tends to be the case, but I have not looked at the report.
Okay. Well, I better ask you then about the bear case. Is there anything that can disrupt this thesis moving forward, or would it be more like a temporary disruption?
Yeah, I mean, on shipping, we have temporary disruptions all the time. You should be prepared for that. I think the bear case here, I think the risk on governance it's low, but that can escalate if political tensions get higher, especially in PRAs. You know, if the Greek government sadly doesn't want China there, they might try to force them out, or they might trade. If we had another really really socialist government on Greece, maybe they try to get the pots back for cheap. It doesn't seem the trend on the politics side. It will be, this is not Latin America, this is Europe. So we should have some protection on that end. But those like long tail risk always exist in this type of critical infrastructure. Then, on the long term thesis, like the call option on China rerouting, Turkey is trying to fight back. Turkey is not going to let all of those volumes and basically have a really good position on that front. They will not give away that for free. So that might be some competition. Then we have some Adriatic ports that they might also benefit from the infrastructure build out and be another option to ship volumes from. So on the longer term, thesis is a little bit uncertain. That's why I think these companies are mispriced. There's no big catalyst, as these are companies that are also pretty central and pretty critical to the economy and have political implication. It's hard for management to give guidance to be a little bit promotive on the stock, so it might not get a higher valuation. It pays a decent dividend. It's around a 6% yield, so that's fine for me. That should grow quite decently, but we might have to wait a little bit to find a good entry price. I think the price is really cheap right now, but I mean on timing. Like wait a little bit for better timing. But yeah, I think they are really good assets over the long term. But this can be that money for 2 years for sure.
Okay, interesting. So value, slow burn, yielding type play. Okay, what else needs to be said about the port thesis? And we're focusing mainly in the Adriatic at the moment. Is there anywhere else around the world that took your fancy from a port perspective?
Mm, Not really. I mean, the main thing is they tend to be quite expensive on many cases or not offer as good growth. Like here we have good growth. Like what I usually like, it's good uncertain growth. That's why the market doesn't price it. Apart from that, this is a Greek security. Most funds don't have access to those or don't even look at them. But Greece has been one of the best performing markets on 2025. It's been crazy, especially they started with banks, and Piraeus and Thessaloniki have benefited a little bit of funds flowing into the region. But I think the Greek economy could still perform pretty well. But that's macro. I tend to avoid those macro calls. So yeah, we'll need to see. Also, another hidden catalyst is more speculative. Is the you know I think it's Euronext acquired the Athens exchange.
Yes, yes, I
So
did hear.
who knows?
I own Euronext. Yeah,
We might get a double listing with higher liquidity. They are double listed on Frankfurt too, but
I think
we
that would
might get improved
I think
liquidity.
that would help a lot because otherwise
Yeah,
you've got to. It's an obscure ticker, and most people out that are not familiar. I think it just simply is under the
yeah,
radar for a lot of
yeah, and
investors.
it's not on most brokers. I think it's I have the Euro, I have Interactive. I think it's available on those two. So yeah, and Piraeus is more liquid than Thessaloniki, but both are decently liquid. Like at least okay, it's Thessaloniki.
It's not that much if you're a North American investor. It's not what you'll expect.
Yeah,
It's very. I would say it's actually illiquid
yeah,
in the sense that I look. I check on my Thessaloniki stock, and it just it never upgrades really
yeah,
because it just doesn't trade that much, and that's
yeah.
because.
The good thing is if you have a fund that gives you some negative beta.
Well, that's true. If you're into all that thing, that's true. You could certainly hedge out a lot of VAR risk and all that other well, rubbish really that I don't really follow. But
Yeah,
uh, yeah, Thessaloniki, Piraeus, Euronext taking over Athens Exchange might give it a little more liquidity.
yeah,
At the end of the day, mate, it's the same old thesis when you think about it. So
yeah,
instead of me buying the producers, I like to buy the royalty or streamers. Instead of me buying a lot of the other major companies or indices, I like to buy the exchange. And rather than buy the shipping directly involved shipping companies or tankers and all this sort of thing, I just maybe buy the end destination.
yeah, yeah,
That's the way my simple brain likes to work.
yeah. That's really interesting. It's like what we've been talking a little bit before the podcast. Is right now I'm focusing a lot on single trend thesis. It's like there's a trend that is usually not a financial trend. For example, here we have the railway build out. That's not usually something that analysts spend a lot of time looking at. So,
Yes.
and it might take a lot of time. So that's some trend that has practically zero effect on the share price. It's a free call option, and it's something pretty decorrelated from most of the other things on the market. This doesn't really have anything to do with AI, and probably wouldn't be affected if anything happened there.
Yeah, I think it's kind of like the Lindy effect. I don't know if you know what the Lindy effect is, but basically, the longer a phenomenon has survived, the longer or the more
Yeah.
likely it is to continue into the future. And I think that definitely applies to these types of business models. All right, now you touched on you've come up with a new term, this single trend.
Mm,
We need to come up with a fancy marketing name for it. So
yeah.
why don't you tell me more about this new idea that you've got, or this
Yeah.
I suppose,
It's
mentality?
basically, with so much change we've been seeing into the market, there's no lots of securities, bonds, whatever, that is really hard to predict 10, 20 years down the line. Like if we had the words from Wise Buffett, one of his main things was, do I know how this industry, how this company will look like in 10 to 20 years? If not, I will not invest in that. I think right now there's many companies and industries we don't know where they will be 10 to 20 years out. And I think it's fine if you are buying something really cheap. But if you really want a long-term holding, you should try to avoid those type of industries. For example, lots of people going into software right now. I have one software holding that is really cheap, but the rest, I prefer to avoid the sector, even though it might be cheap on a screener. It's just what thing I try to do is look for trend. Like a company is going through a process. For example, if a business is going through an internal transformation, we'll later talk about a company that's going from fee based to percentage based. That's a trend. It's really a small trend because it's just one company, but that trend is not correlated with other events on macro, on the market. So I can like have 10 of those situations that are really uncorrelated, and that way I can just make money when I'm right, lose when I'm wrong, but avoid, for example, there's some, hyper scholars, small caps that have like a big call option on data center build out, for example. I am not comfortable with those plays because even though they might be relatively cheap, they are not absolutely cheap. When you have like just one trend, you can ensure you are not comparing to others. In most
Mhm.
cases, you just have your internal rate of return like more similar to what would be a private equity model in the public markets.
Got it. Okay, so there's less of a chain of path dependent
Yeah,
outcomes, and I think that's a very wise thing. Otherwise, you start to get into the second, third, fourth order derivatives, and
yeah,
honest, you're multiplying probabilities, and they all need to go your way. And our high school mathematics tells us that the longer the chain of probabilities are really the lower overall
yeah,
likelihood that it pans out. You mentioned a company that's going from a fee-based to percentage-based or a quasi royalty play. Why don't you tell us a little bit about that? It sounds like you have to come over to Australia, mate, because you're investing a lot down here.
yeah, yeah. That's PharmaX. Some of you might already know the company, others might not. So, quick intro on the company, quick pitch. This is basically, we could say, software. I will prefer to say infrastructure company, but it's digital infrastructure. So basically, all pharmacies in Australia, they have basically, we could say, a piping system that routes all the orders.
Mhm.
The pharmacy, the supplier, the wholesaler. We have like a um, system and infrastructure that communicates everything between these players. That's PharmaX. They have an AD gateway that is basically the language where these communicate. So historically, this was funded by 4 point of sales software systems, the 4 main ones in Australia. So they built this just because they were going to digitalize everything in the industry. Uh, you know, Before that, basically, you need to send a fax or have someone call to order a medicine. This is what allows to order through a computer, through the point of sales for a pharmacy, and to be received into the supplier or the wholesaler. So it's critical. It's critical software. Like, just in case, I've done quite a lot of expert calls in this one, met the CEO. If this goes down, like, they need to go back to ordering manually with a
Yeah.
fax and with a phone. It's crazy the level of disruption that would occur if this happened. It has happened in the past, but just for like an hour, really, really not a lot of time, not big disruption there. So this has been working for a lot of time, and they right now they have a fee-based model. They Pharmacy pays nothing. The fees are paid by the supplier or the wholesaler. The supplier or the wholesaler pay per connection. Like, how many pharmacies are you connected to? How many pharmacies do you want to allow to order through you? And you pay like really small fee per pharmacy. So that gives you the current revenue base. It's really small, 8 million Australian dollars. It's really small company because this company was never thought to be a profit maker, a revenue driver, but due to some strange things, not strange, but really long development. Better not get into that now. This company ended being a public listed company. So they had a really good stream of revenues. They have basically a monopolistic position, and they get those fees no matter what. Like, there's no disruption there. They have no competitors basically. They have some, but they are not really competitors because they don't have the reach. They are not able to do diabetes orders through the government. So basically, even if you go to their competitor that is MedVUX, like they say on the sell prospectus that you need to still have PharmaX. So it's not
Okay.
really a competitor in my view. Like, you can add two because we are cheaper, but you need to still have the others. So you pay
Because
double.
they have the underlying infrastructure to route the orders between the wholesaler supplier and the retail pharmacist.
Yeah, yeah, basically the problem is like it's really difficult for a newcomer like to agree to get everyone to agree on
Yeah.
the same, and then it just doesn't make sense to have two. It's less efficient.
Right.
Like, imagine you receive two type of invoices. It doesn't make any sense, like, for two extra bucks per pharmacy. And then on top of that, we have NDSS, that is the crown jewel of the mode. Is basically, if you order, like, if you go to an Australian pharmacy and you need something from diabetes that is subsidized from the government, the pharmacy needs to have PharmaX to process that order. That's also routed through that. So, really strong competitive position, really strong mode. So then you add here that they want to get bigger because it's a public listed company. They have new CEO. So their idea was, okay, let's make a marketplace. Let's try to compete with wholesalers. Like, let's create a marketplace where smaller suppliers can list, and we have like an Amazon, and we get
Mm.
like a percentage based fee. We are already in the pharmacy, so we can send a salesperson and get them to use that. That was a complete failure,
Good.
and just because they didn't have the enough range of SKUs in order to for this to be useful for pharmacies. But right now they iterated and they created a second version. The main difference here is they went from trying to be a competitor for wholesalers, like, have a lot of other products, have their own platform, to be a facilitator. Like, they are just trying to make the sales ordering process more efficient. That's their key thing. So right now what they have is a pharmacy portal. This is a pharmacy portal that's completely free for pharmacies. that solves the biggest pain point that pharmacists have. Like when a pharmacist orders, let's say I go through a pharmacy in Australia and I order 10 products. Usually, one or two of those 10 products will be out of stock, and it will be impossible for the pharmacist to know until it's too late. Like this data is not live, like they cannot see it straight away. And there's
Right.
also lots of opacity around pricing. Like in sometimes they might not even know the pricing before the product arrives. It's kind of crazy, the problems and the visibility. And PharmaX, as they have all this piping and they have the data, basically, they create a platform that they solve that. It's stock view. It shows the stock on different suppliers, the pricing, things like that. So they have the pharmacy portal that basically is integrated with the gateway. So you have basically lots of data there. They also offer analytics for the suppliers, so they know what's working, what's not working, basically that. So it's really useful for the pharmacies, really useful for the suppliers. And the big question was about the wholesalers, and
Yeah.
especially around Sigma. Do you know Chemist Warehouse, I assume?
I was waiting to ask you about that because
Yeah.
Chemist Warehouse is really the biggest dominant player in terms of the retail mind. So if you want a product, you're going to go to Chemist Warehouse first here because it's always going to be the cheapest and by a long margin.
Yeah.
So do these guys work with Chemist Warehouse or are they kind of in opposition to each other? Because that's going to be a key determining.
The thing in the past, it was a big risk because Sigma recently merged with Chemist Warehouse. And
Mm,
Sigma does not only have Chemist Warehouse, that is like basically a third of the pharmacies in Australia, and also they have like the big ones. So in terms of volume, it's larger than a third. It's basically half of the volume. But they also have Sigma has another third of the market, basically 20% to franchising. So basically, one entity owns half of the pharmacies in
yes.
Australia, are around 60
It's very
to
consolidated.
60% of the ordering volume. It's kind of monopolistic. Uh, so
Kind of.
yeah, so they recently that was a big risk in my opinion. That was basically why at the beginning I didn't want to invest in the company because I just saw like if they are trying to erode their margin, Sigma will kill them. Like it doesn't matter to them like 10 million in cost. Like they can just create this and be loss making, and it's just for efficiency and to keep things working. So they recently created an agreement with Sigma. Basically, they give away for free 10% equity in exchange for being the main Eddy gateway. Basically, they create an agreement. They are their tech partner, which
Okay.
basically means that we give you 10% for free and an additional 10% if you create extra revenues and you do not displace us. Basically, you get a member of the board and we are partners, not competitors. Like we get a vested interest for the big player.
Okay.
On the you
So,
you you secure
mm,
a big part of the revenues, so that risk has gone away.
okay. So now you're saying that PharmaX has a gateway to being the tech partner slash order routing plumbing system of Sigma. It's Sigma Healthcare now. It used to be Sigma Pharmaceuticals, who own basically more than half of the pharmaceutical market
Yeah, but
in
that's
Australia.
that's the big risk that has gone out. That's
Yeah,
not the
that's what
thesis.
I'm saying. So with the merging now, they are one and the same thing.
Yeah, yeah.
Got
Because
okay.
Sigma is not only the pharmacies; they have the warehousing, so it's
Mm,
completely integrated all the industry.
got it.
So here, how they are going to earn that percentage revenues? Like they earn percentage fees, like around 1 to 2% of the orders, only when they generate an order through the pharmacy portal. So the
Right.
thing right now is, as they only generate through the pharmacy portal, they have been able to put most of the most of the suppliers there. Also, Paragon and CH2 as a wholesaler, and they should be able to bring Sigma there too. So basically, right now, the pharmacy portal has most of the SKUs that are needed by many pharmacists,
Okay.
and they are now pushing that. This new platform was out on
Got
November 2025. So right now they are on the selling process on getting these platforms to be used. The first platform drew a lot of interest, but was not useful, so it did not catch up. This platform should be able to generate substantial revenues and to be really useful for the pharmacist and not be a threat to wholesalers and suppliers. So
Okay.
that's the main thesis. Like you are right now collaborating. What this substitutes in some way is like in the past you might have a salesperson going to the pharmacy from the wholesalers and the suppliers to tell you,
Yeah.
we have this offer, we have this other offer. That should be now on the pharmacy portal, so you save them cost on sales, and basically you keep a percentage of that.
Okay.
And
So we've got margin
big
expansion.
big important thing, like most of the, we could say, low margin products are not going through the pharmacy portal. The most of that is like automated. Like you have a supplier for that, it's really low margin, you just get it. Like here is for out of the counter products, like more high margin, we could say, branded products, skincare, uh, aesthetic products, things like that, that are
Mhm.
becoming a larger mix. Right now are 40-50%, like the higher margin products from pharmacies. That part is what's addressable to PharmaX. But that's 20 in total. It's a market 23 billion in volumes that goes through their gateway. If they can capture 1% of 20% of the market, that's poor royalty fees, poor operational leverage. They should be able to pull 40+% margins. This could be a multi-bagger from here.
Yeah. Current market cap's around 70 million
Yeah,
Australian. Very, very small
yeah, it's really small
market
and
cap.
illiquid.
Yes.
So bear
Yes.
in mind.
And so that leads me to ask you, why buy this company versus just buying Sigma and owning it all?
Yeah, yeah. I mean, the big thing here is Sigma is practically priced in to perfection. Not to perfection, but it's not a business that will grow very high. You have here the opportunity to buy a business with an incredible mode that is going a transformation that could do a 5 to 10x on the revenue, and most of that will be straight profit. That's the big transformation. If they are able to pull that, this is a multi-bagger, but it's on the high risk side for sure.
Yeah. Interesting.
And
Sorry. Another point is, and this people miss this all the time. If you look at I suppose the shares outstanding on Sigma versus PharmaX, there is a huge difference. So Sigma over the last few years, and I know some of that was used to finance the merger, they have like X to more than
yeah,
X their share count. So that I don't like that. I've learnt over the years you just don't want to be, even though they amazingly still have a very good return on equity. I just in the long term, that's not your
yeah,
friend.
yeah. I mean, one note important that might draw attention is Dennis Bastas is on the cupboard of PharmaX through one of his entities. He's a pretty big guy in pharma in Australia, so that should have some backing there. He has a board member in the company too.
Yep. Okay. What else do we need to know about the technology space? I think you've got another company in
Yeah,
Europe.
another here we were on the conservative side with the
Conservative technology.
with the Greek pots. Now we are going on the growth side because we are talking about royalties. Royalties are too expensive for me, so we need to talk about companies that will become royalties. So that,
Okay. All right. I like it. The prospect generators, my uncle Rick would call these.
Yeah.
Now, all right, we'll leave the expensive aspect of royalties for another day. You and I can talk
So
about that in a whole podcast. But this is interesting. This is something I know nothing about. It's technology. So why don't you tell me a little
it's
bit about
it's
this new
Sing Machines is called. This
what,
company,
what, what,
yes,
what
Sing Machines is
seeing
SEE.
machines?
It's
Okay.
in the AEM on London. We like the stocks on places nobody looks at.
It's in the developing markets. London's now a developing market.
Yeah, practically South Africa. So, it's a company that its headquarters are in Australia, but it listed in the early 2000s when it was pre-revenue. Basically, this was a spin-off from Australian University. It was just theory.
Ooh, okay.
So yeah, this was listed in the early 2000s. It has gone nowhere for 20 years.
I can see that.
They have
Like Australian
burned, they
University.
have burned around 400 million in research and development over those 20 years developing this technology. The company Sing Machines, what they do is like when it's for the Australian guys and the US guys, this might be a little surprising, but in Europe, starting July, all of us will have a camera in our car that will check if we are distracted, if we are, drowsy, and, something that might
More
impair.
regulation and control in Europe. I'm
Yeah,
shocked. I'm
yeah,
positively shocked.
basically. So the thing there is you need what's called a camera-based DMS system that basically tracks your face and gives you a warning like ding dong if you looking at your phone, looking by the window, something like that.
Well, what happens if a pretty girl crosses the road in front of me?
It will do
I'll
the
stop
do
my
the
car.
same.
I'm never gonna catch up to her.
Yeah. So July 2026, every car will need that. Every
Every
new,
single car.
yeah, every new car sold, not
I
the
was
old.
gonna say, do
Like,
you know how many
yeah,
old bangers are roaming around southern Italy that
yeah,
are not registered? That okay, all right. So
yeah.
new car
All the
sales.
new cars sold
Okay,
in Europe. Like,
all right.
no matter where it's built, cars sold in Europe.
Oh wow.
So
Okay.
the thing here is there's only two players that develop this kind of software, and two players control basically all of the contracts that have been awarded. One of them is Sing Machines, which is the company we're talking about today, and the other one is Matai. We'll talk about the difference in a second. So first of all, why is this interesting? A company that has made no profit over 20 years, zero returns for shareholders over 20 years.
They have
So
been
because
burning millions of dollars every
yeah,
year for
yeah,
decades.
but as I like to say, the harder it is to grow, the harder it is to disrupt. So they have spent so much money here that they are leaders on the technology. And right now we are going into a ramp up that should finally showcase the earning capacity of the business. Like the numbers here, valuation pitch, this is around 200, I think it's 160 million pound market cap.
Yep, 156,
Enterprise value, I think it's around 240
180.
USD.
Sorry,
USD.
USD. You could be correct.
They
USD, yes.
report in USD. So 240 million USD. Uh, by start of 2027, they should be able to generate 10 million free cash flow quarterly. So 40 million annually. That's a pretty good yield, basically 1 year out. What we will need to go later, what that implies. What's driving the regulation? It's called ESR regulation, and that's been in place. Like that's already in place. Like I think there's really low probability of that being pulled. Another yeah, it's practically impossible. All the contracts are set. All the automakers are already producing the cars that will be sold post June. Post June. Uh,
Okay.
it,
With
it
that,
just, So the thing here is we have minimum contract, minimum royalty warranties. We have 400 million in backlog awarded. And I mean, there's lots of nuances because this business is really poorly understood. First, let's explain why this is not priced well. First
Okay.
factor, the market does not believe the ramp up will ever come. Why? If you take a look at the share price of this thing at 2021, 2023, it went to the moon, mainly because this technology was recommended. Like the market thought, all of these OEMs will put this technology because it adds like safety points. But we had the
So it
Chinese,
wasn't mandated.
yeah, not mandated.
Mm.
So you had all this Chinese competition, and practically nobody put the technology on the cars. The difference now is this is mandated, but the market has completely lost trust on the company. And second point, it has not yet showed a quarter profitability. It will be these next quarters, the first half of the calendar year 2026, they will be cash flow positive. Um, Supposedly, there's no certainty of that, but they are above break even right now at the current volumes. They should be above that.
Really?
Um,
Okay.
So the thing why this is mispriced is the market is concerned that they are not being awarded industry-wide contracts post 2028. Like most of the contracts run, 2029,
Um,
things like that. The programs 3 to 5
so,
years per car, even 7 years, but we are not getting contracts for the newer models.
so what's the durable competitive advantage of these guys then?
So main thing here, I mean, first, a detail there is that we are not seeing this. We need to understand where they sit on the industry chain. Like they are
Okay.
not a tier one. There's a tier one that negotiates with the OEM. There's then tier one negotiates with a tier two that develops basically the system, the camera, and everything. And the tier two negotiates with Sim machines that they provide the software.
Okay.
So big difference around this part of the chain because this is a complicated company. This is a complex company. Sync machines, what they do, it's consulting plus offer the software. Smart Eye, as far as I've been told by management, I have researched, they just offer like a software library. Like I give you the software, you need to figure it out on your own. Like you're the own engineers adjust. Like Sync Machines has expertise on optics and on the software side. So basically, the tier two goes to Sync Machines and they say, okay, like we have this hardware. How can we make it as cheap and as high performance as possible? And basically, Sync Machine says, how much is your budget? And they say like $5, basically, and they adjust around that. Very important because due to this work that the company does, they are able to pull basically about 2x the pricing per royalty per unit compared to the competitor because they pull out cost out of the hardware so they can charge more for the software. That's a
Okay.
big part. So once understood that, we are not seeing contracts post 2028 because there's a big mess around OEMs. And basically, they are just awarding extensions. Like, we will just keep working with the same guys. That's
What are OEMs for the viewers?
OEMs like Renault, Volkswagen, like the car company, basically,
Okay,
the one
got
that
it.
manufactures. So yeah, that's important point. Then what needs to happen for this to hit 1 million 10 million free cash flow per quarter? Main thing, the ESR, the ramp up on royalties. There's 16 million cars in Europe, basically sold every year or expected to sold this year. Uh, they expect to have around 50 to 60% of that market according to the numbers I've made. So that goes like to 2 point something million per quarter. With that, that's 100% royalty. I assume like 8.5 uh, dollars per unit. So that, that pulls pretty significant, like around 16 million per royalty, a little bit, 17, 18 million in per royalty, 100% gross margin revenues from that front. Then they have another division that it's called aftermarket. Here on that front, this is for trucks. Basically, you have a fleet and you retrofit. Uh, they offer hardware, software, and monitoring. It's complex
Okay.
company. So
Yeah.
here, basically, you have a fleet of trucks, and this is for a company that it's having troubles. They had some accidents, they had someone suing them because they were not, ensuring that the truckers were safe. So they target those type of customers. There's rumors that Amazon, it's a recent customer win. I think there's a big chance of that being the case. They started with a trial of 1,000 units that could go to 17,000 units.
Okay.
So here they are. This is one of the technological modes because you need data to train here, to train on the face, to train on the eyelids, on the direction of the eye. They track
Mm.
all of that. So in the OEM segment, like a normal car that just has the software, they cannot train on that just because that's a privacy. You cannot have a camera on your car that an AI is being trained on. But
Okay.
on the aftermarket, most clients let them train on the data, mainly because you have the camera, you have the software, and then you have like basically an Indian guy that checks what's happening on that camera.
Okay.
So that they sell a recurring subscription for that monitoring. That's also
Monitoring who's monitoring the Indian guy that's monitoring the driver?
that's not true. So big advantage is they can train on the data from the trucks. They have
Yep.
millions of miles. That's
Mm.
really valuable data because truck drivers that are driving 10 hours,
Yep.
12-hour shifts, you see clear signs
Yep.
of
That's
what they are trying to solve. They have already deployed tons of units, so they have lots of data, and they have like it's pretty well tested. The best solution that offers the minimum amount of false positives. Like something a lot of people are already complaining about is you are like this, you're driving and it just keeps bothering you because it's the case. It maybe is it for example here you might have a false positive out of like 20, like 19 false negatives in some solutions. Right now, it's really, really bad because the regulation doesn't require to test for false negatives, for
I
false
see.
positive.
Okay,
So
so
basically,
you have
they have shitty
20
solutions.
is of type 1 error.
Yeah, basically, they don't care. It has lots of errors. But especially in the truck side and the fleet side, it's really important, that factor. It's really, really important because we have cases where the truck driver just takes the device and takes it out of the window because if over an hour that thing is beeping 40
Yes,
times,
that's
it's
annoying.
just impossible to work with that. Or they cover it, or you know, and if they cover it, it just
The
makes
wrong
no
one.
sense to have it on the first place. So they've already have a new solution that is even better than the old one. The churn is really low, contracts are long. So that's also a really good business unit. The for We already explained what needs to happen in the OEM side. Here to reach 10 million, they need 6K units sold per quarter over the next 4 quarters.
Okay, so what
Basically,
does that mean in
they need.
terms of new car sales? What happens if new car sales slow
No,
down? Does
here
that matter
here they
to them?
don't. Here is retrofit.
Sorry, this is the aftermarket
Yeah,
sales.
this is the
Okay.
aftermarket. Basically, 6K units. So that's the main thing. Here, after talking to management, they are also exploring having like a white label product. Like it's basically their software with a cheaper option. Like, these are pretty expensive devices. From my estimates, is like around $600 per device, which is pretty expensive. And to get this on most trucks, it's just not an option. So they are exploring already some options to do like a white label, very cheap product with some Chinese player. So that could be interesting also. So those are the two main assumptions. It can be some variance there, but I think they should be able to reach 6 to 10 million in free cash flow.
Okay. And so what does that mean from a price targeting perspective? And does this company, I think I know the answer to this question, but I'll ask it anyway. Does this company have an options market? Seems a bit small for that.
No, I don't think it has an options market. So on pricing, we have some things. We have a call option that this technology can be used for robotics and humanoids. And Mitsubishi Electric, it's an owner of 20% of the company. This is Mitsubishi Electric, not Automotive.
Yes, I
Electric,
understand. Yeah.
yeah, Electric. It's on the side of robotics industrials, and they are working with them to develop solutions with their tech for industrial, and they've highlighted robotics and humanoids as a possible use case. So just the announcement that they are going to work with Mitsubishi on that will be quite crazy. Then we have you know 10 million, 40 million free cash flow. That's price tag, 10% free cash flow yield. That's around 400 million market cap. That's over a 2x from here. And
Mhm.
if we see continued growth on the aftermarket side, the multiples should be better. But I think we have some pretty good catalysts over the short term. Q3 KPIs, I think, should be good. Uh, Here we should have a small note about them versus SmartEye. SmartEye doesn't report lots of the KPIs that they report. Like, they don't report how many units they are installed in each quarter. So a big
Okay.
part why Shin Machines it has not as a good valuation is because they are more humble, in my opinion. Smart Eye, they claim they are the leader of the market, but they are the leader of the market by only one metric, and a metric that they self-report and self-calculate, that is design win. So you know, it,
Smart
I
tells everyone that they're the best because they say they're the best,
yeah,
basically.
that's basically design win. Is like you are going to have like one card with your system, but they don't specificate like how big. Like one one contract win that is 100 units is reported as the same on 1 million units. It
I
makes
see. They don't
no sense.
specify the degree of the new
Yeah, and in
contract.
terms of cars on the road and volumes right now, Sigma Sins is 2x larger, much larger. And in terms of tech, they are also a leader on false positives, all of that. They are better. So the we should see the ramp up in Q3 and Q4. That should be pretty interesting to see. So that's another independent trend. Like, it basically doesn't matter what happens with AI, with the economy. If the ramp up happens, this will be 2x or a multi-bagger. If it doesn't happen, it's minus 50%. I
Okay.
think there's a
Okay.
higher chance.
Now you're getting towards why I asked about the options side of things.
Yeah,
This to me, and technology, you've got basically a binary outcome. So
yeah,
it hits or it misses. In those cases, I don't want to be a long-term holder of equities. I want to control a certain amount of the binary outcome. So
I
you're
agree.
you're saying you've got a downside, let's say, of 50%, and you've got an upside perhaps of 100, maybe 200%, who knows? that to me seems a low asymmetry. I'm just sharing a screen for audio only listeners of the price spike that you mentioned going back a few years.
Yeah,
So where are we? 2020. I mean, that was a very substantial run up. That was a multi
yeah,
bag.
yeah. I mean
And if I'm
that could happen again. If
and that could happen again. That would be where are we? $40 billion market cap. So that would be a little more than a 2x from today's
yeah,
16 billion. Just for context.
yeah. Like for context, Mitsubishi bought at around podcast valuation 4.5%, and we are at 3.3 right now. So it's substantially below Mitsubishi purchase price.
Okay. So roughly, what does that mean from a market cap from Mitsubishi's? What was their entry price? Do you remember?
4.5.
Billion. Okay.
Yeah.
4.5 pounds USD. What are we
No,
talking?
pence. Pence. It's 4.5. Yeah. Yeah.
Great Britain pence.
Yeah.
Use real money, Brits. What are you doing? Okay. So interesting. So we would think they need to recover their investment, shall we say?
Yeah. The really interesting thing is around the possible collaboration on that front, because this was, strategic investment because they wanted to be partners. This was not, an equity investment. We want to make money. This was, we want to make partners to, to present this guy
Yeah.
to some
Eventually.
others. We need to have some skin on the game.
Okay. I don't know. I steer clear of the SoftBank style.
Hmm.
Himetse Masayoshi-san he is who he is, and I am who I am. But anyway, it's very, very interesting. If it had an options market, I might buy some calls. We'll see. Interested in PharmaX though, so I need to do a little more homework.
Yeah.
God, it was like 6 months ago when I think you wrote about it, and I said I need to read it, and I just
No, it was quite recent, because
was
I
it?
was initially an skeptic on PharmaX, but a friend of mine, pushed me to do some deeper research because it's not very obvious the case.
Well, I think, and this is just what's going through my brain, is with PharmX, you have a decent base case. It's not such a binary outcome. And now that
Yeah.
they've got an agreement with the biggest threat, which was Sigma
Yeah.
Healthcare, I think the odds are pretty good that
Completely. Yeah.
they can compound it. And their business really, it doesn't need capex. It doesn't need innovation really. I mean, yes, they
Yeah.
need to do upgrades, but it's not a capital heavy business. Seeing machines, probably leave that one to the texters and
Yeah.
youngsters like you that
I
understand this
agree.
better than I
Like
do.
the thing on Shin machines is like what they need, like to start making money, is the GSR regulation, and that I think there's a really high chance of that going and happening.
Yeah, sure.
It's
And
mandated.
it's always a good bet that a new law will be passed in Europe. What else? Anything else you want to share? We've covered a lot today,
Yeah, we
sir.
covered quite a lot. I mean, those are the main, capitalized stuff. I've been capitalized or royalty fee based that I'm interested in. Then, I've been looking into some companies. I still have some of my offshore names on the cheaper side. They have moved less than Valaris. Not happy with that. I should have
I
just,
tried to tell people, but they
yeah,
didn't listen to me. What can you
should
say?
have just stick to mainstream instead of buying a Norwegian player.
Yes, actually, that's a good point. So I did receive some comments about the Norwegian slash
Yeah.
Scandinavian control company. So in the past, I've owned not just offshore, but NORAM. I no longer own it, guys. Just full disclosure, I've got more than what I needed out of NORAM. Uh, People thought it was a Norwegian company because Friedrichsen owned, 51% or whatever he owned. Um, Question is around the tax issue with Norwegian companies. So, how do you see you justify buying Norwegian style stocks or Norwegian domiciled
I mean,
stocks?
if you are from Europe, like you should get like the tax back, but it's a lot of paperwork. So if you are going to invest little money and you don't have an accountant, you know, probably
maybe not worth.
can be a pass for you. Even it's not such a big withholding tax. And right now they are doing the dividends of capital returns, so they are not really dividends.
That's the thing that the biggest point I tried to make clear was, look, you have a capital return. It's not a taxable event, and
Yeah,
it's
I
a
have
little.
to recheck like how many capital returns can they make until they run out of those. But I think we should have still 1 2 years on that.
Okay. So you mentioned Valaris, which was a bit of a frustrating journey for me, but eventually we got there. I thought it would be worth, the replacement value was worth even more, but given that
Yeah,
they're being acquired slash merging with Rig, it's not a balance sheet I want anything to do with, so I'm out. I own a little bit of said energy thanks to your work, and that's basically it, mate. Other than
yeah,
Petrobras, which kind of contract the drillers. How do you see the
yeah.
space evolving?
I mean, I like the thesis. I think, we have lots of things going on right for the offshore thesis to work, which is, countries want energy reliability. Even Europe, is
Mm,
starting to realize that having, some oil reserves is not that bad. So,
right.
we might see the scenario where countries like when we saw with Turkey with El Dorado, I think they just buy some rigs and they take off of the market just for national purposes. So I think it's really attractive market. If you look at ODG, it's basically trading at 700 million per rig per semi sub. It's quite crazy on that front. I think although the market is already pricing a big part of the upside. Like if we take a look at the big players, Transocean, Valaris, Borg, they are pricing free cash flows of having day rates much higher. For me, this is an asset. Like there's some guys that they think these assets will run forever, and the last cycle argument. I'm not a big believer on that, just because I don't tend to bet on this time is different. I don't want to do that. Sometimes I do, but on this type of big macro, it's really difficult to guess a sense, because if you are right about oil, you might be so right that they start making new drill ships. So you are a little bit.
Yeah, I think the issue there, people have looked at these shipyard constraints and they just say, look, it's going to cost 1.2, 1.3 billion. Last I checked, it's probably moved since then.
Yeah,
To build what would it be, a G by that stage will be up to 9G drill
yeah,
ship. So, you've got this runway where those day rates can be underwritten with a certain amount of certainty. And I think that's what the market's pricing in. However, Transocean still bumping its head around $6. It hasn't really
yeah,
had a chance to break out from that. And
yeah.
again,
But I mean, right now, this asset, like if you are DCF, 15 years, 8%, no, I mean higher for this type of asset, like 10 12% DCF. This is a 7x free cash flow multiple asset, and they are trading at near 20. So they are already pricing quite a lot of increase in their
yeah,
rates.
I mean, I don't know if it's, yeah, the multiple. I guess you can argue one way or the other. Replacement value wise, there
Yeah,
might
that's true.
still be some upside, but look, again, how are they going to get from here to there? Yeah, their balance sheet is a little better now that they acquired a new balance sheet
Yeah.
effectively. I don't know. Um,
My main problem is I think we are getting ahead of the numbers. Like their rates have not
right.
risen yet.
Hmm. Hmm.
Like, if we get some bad prints on their rates, some bad contracts, which, I think they should probably be good. But the risk reward now, it's worse than it was 6 months ago.
Yeah.
And
Yeah.
I just prefer to own, less lower quality names that, they might be assets, smaller assets like tender rigs that might get easy new supply because, the price tag is lower. But I just prefer to pay 5x cash flow than 20. It's just that.
Yeah. That makes sense. And if you look at, let's just say, because we're on the topic, call it rounded up to 7 billion market cap for Transocean, and then the the enterprise value is more than double that given the balance
Yeah,
sheet.
yeah,
And I
it's
know
really
I
high.
know that their strategy is to hold out, not to do a restructuring. I get that. Um, but it's worked out a lot better just picking the company with the biggest balance with the better balance sheet
Yeah,
versus a said energy of 600 million. I mean, if you're looking for asymmetry purely through equity, which has a larger chance of providing a multi-bagger return? That might be one question. And if we've got this thesis where it's going to take time for the day rates to play out, but eventually we're going to get there, we might have a multi-bagger opportunity. Is there a world in which oil or energy, hydrocarbon energy does well and the royalties do not do well?
yeah,
Mm,
it's high.
I don't see how that happens. And in the
Yeah,
meantime, all you got to do is wait. Whereas there are a
yeah,
lot of risks in terms of operational risk. If there's an oil spill in the Gulf somewhere, Transocean is in a spot of bother. Um, if
yeah.
you're in
And the
West Texas,
problem with
you don't
if
never
we
know.
are talking about these declining industries, if you have debt, you have really high leverage to the
Mm,
terminal value. Like
mm.
I want an asset that can redistribute to me, like in dividends, buybacks, whatever. I don't want an asset that, after 10 years, they will need to pay back that debt and they cannot distribute anything to the shareholder.
Likely
That
in a
is
high interest
huge
rate environment.
swing. Yeah, it's just much better. And the main thing I'm seeing is a little bit of a red flag is for this to be a declining, contrarian industry. The market gets a little bit too excited when an acquisition is made. That's,
Well, if Polaris is an indication, yes, certainly.
yeah. For example, I own NCR Leos, Brinks. I own, I sold after the M&A announcement.
Which
Bring
company?
NCR Leos. They made ATMs.
Okay, don't know.
Yeah, basically, I really sold really good IRR. I think almost 100%. In August, sold recently for like 40 plus gain.
Cool.
So Brinks, another company bought them and it fall 50% on the day the M&A announcement. And even though it was quite accretive. So, those are the type of industries where they are truly contrarian. I'm just seeing there's so much consensus about offshore that is getting you. But as the recent interview of Druckenmiller, the crowds are usually right. So we don't need to be contrarians just out of the sake of being
Yeah,
contrarian.
yeah, I agree. I agree. It's a good point. All right. Well, guys, if you're interested in any of the topics, and I think we've come up with some
Yeah,
gems in our past conversations, a link to Undervalued and Undercovered. Is that
yeah.
correct? Yep. Undervalued, Undercovered. The name of Hugo's Substack will be in the description. Make sure you check it out. There's a lot of value there for sure. Thank you for tuning in, and we'll be back with another episode shortly.
Thanks.